Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence. This is going to be the best panel of the day because I've been in a few panels and this group here is awesome. We're going to keep it as focused on content as much as we possibly can. First, I just want to say hello. First, to my left is Jackie Rosner, Mike Severo, Aline Carnizelo, got it.
Perfect.
And Stephen Klein. One thing I've learned about speaking with my colleagues recently is they do it. I just say it, senior commodity strategists, and one thing we've agreed on is a bit of a tip-off for this panel is we all have been, we all remain bullish gold. That might be an issue. And one thing that most people I've learned in this environment have not heard is, have you heard the term boomer rocks? That's right, you haven't. Boomer rocks is what crypto people, typically you're under 35 something, call people who invest in gold. It's called boomer rocks, and people invest in those boomer rocks. But we're going to start out with gold. We're going to talk about the outlook for gold and where things are going and where we think they're going to go. I'm going to start out with Aline, who's more focused on a little bit of the long-short part of the scale. And the key thing to remember about commodities, with the exception, notable exception of precious metals and most notably gold, is most commodities go down because they went up and go up because they went down. And one thing Jackie says is stock markets are about hope, commodities are about fear. So let's bring that out. So your thoughts on where we're going in this space and what you expect about gold and what are the nuances we should expect investors should be focused on?
Yeah, absolutely. So at the moment, like commodities, like as a broad category, right, is at the heart of what is happening in the world between bifurcation of supply chain, higher for longer inflation, decarbonization and green investing, and geopolitical risks and tensions from that. All of it, at the end of the day, becomes about hard assets and how to secure your supply chain. And within that, a scenario of hoarding materials, either indirectly or directly. At the moment, for example, we have a lot of copper coming to the US in anticipation of a tariff that might come this year. The tariff is not even in place. The copper is coming from the US and tightening Chinese and European markets. All to say that, you know, we are trading in a world of, the world is, flat, interest rate is close to zero, and inflation is close to zero. We are now in a different paradigm. We are in a deglobalization world where inflation is higher for longer. The world is bifurcating supply chains. At the core of it remains commodities. And within that, I'll add the mega trend of de-dollarization that we're seeing from the Western markets. So I think gold in particular and other hard assets of commodities like linked commodities to the industrial side are both benefiting from these mega trends. In particularly gold, if you think about the treasury markets and people looking to diversify their holdings from the US dollar in treasuries, gold market is 1% of the size of the treasury markets. So when we talk about, diversification of allocation, you only need 1% of people that are currently investing in treasury to double the size of the gold market. So that's why we see this trend, and particularly on central bank buying as well, and now retail, and now institutional, pushing those hard assets up. We used to be 15% of the overall AUM of financial categories. Commodities now is less than 2%. There's a lot of room for this category to grow in this scenario of geopolitical uncertainty. And I think where specialists like us do well is exactly identifying the underlying fundamentals of those commodities and where you can get most exposure that uncorrelated to equities and credit.
Can we work down from your, Kevin, your way? Any things you want to expound on what Aline said, or focus on more what you do? Your space, you're more focused on the long, short, and trading, and a little bit more in China and China yuan-denominated type commodities, and different ways of tracking markets or watching markets.
Yeah, no, so I'm Stephen Klein from AFBI, and we are a multi-strat, and one of the strategies we have does focus on Chinese commodities. but we are very much quant, right? So though in general I agree with this view that gold should go up, that's not what we do at AFBI. Instead, what we're focused on is much shorter term trading, and particularly in gold. If you look at gold and the wonderful move that it's had from 1,000 to almost 4,000, that move primarily has only been easily profitable for longer term holders, for personal accounts, or for much shorter term trading. If you look at traditional kind of medium term signals, it's been unprofitable. And so at AFBI, we're really focused on the differentiated market access, China point, and also differentiated data. And so, one of the things, we like to consume positioning data from all around the world, and with that positioning data, coupled with much shorter term signals, all of a sudden you get a very profitable experience in gold. But what I also think about is that I know gold is kind of a secondary topic of this panel. It's really hard commodities. And so gold has certainly realized its promise of going from 1,000 to 4,000 and maybe further for a lot of views that we've all had for a long time. But also in this point about the Chinese denominated commodities, Chinese commodity futures markets are the most liquid listed futures markets in the world when it comes to commodities, where the rest of the world maybe has 3 or 4 super liquid commodities. They have 20 to 30. And the speed at which they have been internationalizing, each step of it goes much faster. So they came out with internationalized futures. They announced them in 2014. Took until 2018, 4 years for that to happen. Then they came out with qualified foreign institutional investor, which is QFI. That was announced in 21. It took until only 22. Now they've announced that Shanghai Futures Exchange is going to open their nickel contract to being able to deposit foreign currency rather than CNY for margin. And it's very interesting they started nickel. All of us have had a good kind of laugh about LME versus SHFI from back in 2022, which is also something AFBI did traded very profitably, being long nickel back then. But I think that this next leg of the not only looking at gold as such a great, successful, hard commodity, but also the idea that we may have to pay attention to things priced in CNY more. I think that's hitting warp speed right now.
Well, I'll tilt over to Mike. One thing I want to mention is you mentioned China. The 10-year note yield in China today is 1.69%, severe deflationary forces, just trying to catch up and extrapolate, and they're exporting that to the world. Mike, any thoughts on that? And then what can we think of beyond gold and the outlook, or whatever you think? There's other hard assets and commodities.
Sure, yeah. I mean, I think one of the interesting dynamics that we've seen front and center this year is true regional dislocations, and a lot of this is driven by policy, where predominant markets that we can think of as directional now have like huge paradigm-breaking relative value opportunities, which require knowledge in treating gold, for example, as a true commodity. A large subset of the market thinks of it as a financial asset, but when you see the difference in price between Shanghai and local London, when you see clear instances of, like we were talking about gold lease rates, levels of backwardation, levels of contango in London markets deviate materially from the US, suddenly there are like very compelling relative value opportunities, and you have to be very thoughtful of the data across that complex in each of those individualized regional markets. And this turns into a dynamic where you can think about these commodities relative to themselves in various locations, which creates compelling opportunities, not just for outright direction and trying to predict, the continuity of the current regimes, which can be very difficult, but think about these commodities relative to themselves, where you can kind of hedge out a lot of the forward paradigm shift and focus on things that are more measurable.
Go ahead.
Well, actually, at AFBI, we're super focused on liquidity, and therefore we're focused on these listed futures markets, be them in China, the US, or Europe. And it's been so interesting to see that all of a sudden delivery point, of listed futures markets has become yet another alpha that we can trade. And so earlier this year, you saw it in gold, you saw it in copper, but copper really sticks out to me. In February, the trade was all in China, but then in March, the trade was all in the US. And to have yet another signal that you can jump around at our much faster time frame was very valuable to go from one to the next.
Yeah, I think we are sitting, as I mentioned, like in a special period on a high-level basis where we are changing at the same time the way that we produce what we consume and where it's produced. And this is, for me, very critical in the sense that you're moving production away from where it is most, productive, where it's the cheapest place to produce, to where it is politically driven place to be produced. I'll give an example of aluminum. Aluminum is something that is produced, it requires 80% of the cost of production. Aluminum is energy. The most efficient way is to put it in China next to a hydro plant, right? Becomes a really not only ecological based aluminum, like low carbon, but also cheaper aluminum. As soon as you start talking, okay, we're gonna put these aluminum tariffs into the US that now is currently 50% to incentivize new production. It is a challenge all across the place, right? The first one is where you're getting this electricity. So now you have, data centers and you have aluminum production competing for electricity. Central Aluminum said, okay, I will, build a smelter here again in the US. It has been looking for 2 months now, and it cannot find a long-term electricity contract to fit its demand because this is hugely energy-intensive production. So once you onshore that kind of production, when it does, it will come at a much higher cost. So I don't think this is tracking when we think about inflation at a high level. We think about it, here's the impulse of inflation from tariffs. What you have to think about, here's the impulse of inflation from producing things that are not wouldn't be there otherwise without these tariffs, and guess what? Much more complicated and higher costs to produce here. These are ultimately different production costs. And then you go into the supply chains, and we study a lot the supply chains, then you're talking about how much expensive is gonna be your car if you're producing your steel internally, if you have 50% of steel tariff, and then you have 50% aluminum tariff. There is an exponential cost into the end product that is your car. So all of this is creating, as we said, it's no longer a case of one world, one commodity. It's now many worlds, and each commodity in one place will have their own dynamics. That for us, obviously, as a humanity, unfortunately, the productivity factor is likely decreased from this move, but from an allocation point of view, creates much more diversified sources of uncorrelated returns that we can leverage from. And what we see as the end result is likely be as lower GDP overall, but a much more commodity-intensive unit of that GDP, because all you're seeing, and particularly Western governments that will not have access to that US consumer through these tariffs, they have to impose their own domestic demand. And the way to do that is to invest in their own infrastructure, and the rearming plan becoming also decentralized. So you see the world moving into rearming, infrastructure, electrification, all at the same time. All of this super commodity intensity. So even though the GDP overall is dropping, the intensity of commodity of that GDP is increasing significantly. And that's where I see there's a fundamental reason why this asset category has to represent more than what it is today, and why it has a role into people's portfolio.
Jackie, so I appreciate your patience. Just tilting back a little bit, some things we discussed earlier was about, first of all, what can go wrong with gold? I think you're quite bullish gold. What could go wrong with that space? And things that Aline pointed out about some costs, but it seems like for miners, some of their costs are declining. You're seeing that performance lately. Anything you want to extrapolate on this?
Well, I think first I want to thank iConnections and MFA for hosting such a great event and for inviting us on this panel. It's always happy to be here. It's a great thing. Before I answer the question, I just want to say another thing. A few people asked me today what's going on with my hair, and what's happening is just like 2.5 years ago, I have a bet with Powell that I'm not cutting my hair until he starts cutting rates. And I still haven't met him in person. I don't think he knows we have this bet on. and I don't think I'm going to get a haircut until next year.
So he's got 10 months left. What if he leaves before he cuts?
But even with no rate cuts and high real rates, gold is still up a lot. So there's some points I want to talk about that. About what could go wrong. Number one, gold, it doesn't always do things that people think it would do automatically. It's not a good hedge for inflation. We saw in 2022 when inflation peaked, gold finished the year flat. We saw plenty of times in risk-off periods when people need to sell assets to raise cash for margin calls, everything goes down. Liquidity dries up, volatility spikes, correlation spike. People will sell gold as well to raise cash. So we saw on Liberation Day when stocks dropped 10, 11% in 3 days, gold dropped 5%. So, these things happened. 2008 with Bear Stearns and Lehman, gold still also went down in those periods. It finished the year slightly up, but it's not a risk to quality type asset. But there's plenty of reasons now why it should be going up. A lot of people are concerned with the runaway, debasement of currency, debt crisis. The debt levels are really massive, global trade war. And most important is these central bank purchases are going on. These are very big, strong tailwinds that are going to continue. And I could get into that in a moment. But you were saying about miners, about what's going on there. Miners, which is a bit of a beta play on gold bullion, has gone up a lot. This year, gold is up about 27%, and large cap miners are up twice as much, or up over 50, 55%. And it should be going up because the stuff that they're pulling out of the ground is going up. Their energy costs, a big cost of their input, has been going down a lot compared to where it was 5 years ago with oil prices on the decline. And also, most important, their labor costs denominated in foreign currencies. If you look at where these mines are, Canada, Australia, South Africa, all these currencies are a lot weaker now than they were 5 years ago. So with cheaper labor costs, cheaper operating costs from lower energy, and bullion going up, that's why miners are going up. But miners are a very risky asset. Plenty of times they've sold off, and they've sold off hard, much more than the price of bullion would suggest. There were plenty of periods we saw recently in the last several years where miners, really got hit. In COVID lockdown, they just completely collapsed. Q4 2018, when there was a big stock market sell-off, miners also went down. It's not a flight to quality asset, even though it's a beta play on gold. So they're definitely big risks. But what's quite amazing is that gold is up so much this year, in a year where real rates are still high. And that's because it's not a question, you have to ask yourself, why are rates high? It's not high because we're at maximum output, full employment, maximum demand. It's high because people are worried about debt sustainability. And when you have these fears and concerns and uncertainty, gold loves uncertainty. So this is probably going to continue. But most important, I'd say the number one reason that gold and miners are going up is because the central bank buying, it's a huge structural tailwind supporting gold. You have to ask yourself, who's buying? Russia and China central banks have been buying so much more than everyone else. And even taking out the large top four holders of gold in their bank reserves, US, Germany, Italy, and France, take them out of the equation. Look who are the other big buyers. Last year it was Poland, Turkey, and India. And these are banks that have about 10% of their reserves in gold. There's about 18 or 20 other central banks with bank reserves over 100 billion that have their percentage of reserves in gold much less than 10%, and they have plenty of room for them to add. So there's a lot going on now with reserve diversification, and this is not going to go away anytime soon. So big support.
What if we get a little détente between China and Russia and Ukraine, and the stock market that keeps going up? That seems like it'd be a problem for gold. Is that like the number one thing?
I wouldn't say number one thing. In the last 20 years, it's very interesting to see how gold has outperformed the S&P. But long-term S&P and just large cap equities should do better than gold long-term. I mean, gold has had many years of boring, so I think, now it's time. Gold is shining the last 2.5 years, probably going to continue the next couple of years. But even with it's not directly correlated with the stock market. It's really hard to say. I mean, gold has gone up in years when stock market has gone up. It's gone up when stock market has gone down. So I wouldn't say it's like a driving factor, but for now it seems that the trend is up. But it's a risky asset. Gold is trading at twice the volatility levels than S&P. has to be weighted accordingly, So gold could sell off. It probably won't sell off more than 10% because there'll be huge buyers at around, 3,000 level, which we're very far away from that now. It's like 3,350. The CTAs are long it. They've been long it for a while, where they're medium-term or long-term CTAs. They're not letting go of it. There's been some decent-sized breakouts. But if gold could take out the prior reaction high of 3,500, you're in uncharted territories. Then it could just, keep going. It's really hard to say how high something like this could go.
Yes, on to this point about gold correlation in the S&P and what happens there. So, over my career, I've obviously migrated to be a much faster time frame trader today than I was back during the Lehman crisis. But back during the Lehman crisis, at all times, I was managing, long or short 1 million ounces of gold, which is 10,000 futures. And so in '08, we were geniuses at Tigris, and we were out there buying gold, 10,000 futures worth of it, from about 760 to about 720. And sure enough, come the fourth quarter, gold almost in a straight line after recovering up to 900, went to 650. But what was amazing about gold was gold at that time was so much stronger than equities that when you got to March of '09, equities were making the low of 666 that we're all very familiar with. But gold in '09 would sure enough get back to a new all-time high. And so I do think that, yes, you do the supply, demand, liquidity aspects, and shorter-term trading can do a great job of making money in both directions. But it is amazing that when you have enough demand and often, world recycling of reserves, as you do right now, and as you certainly had in '09, into gold, it'll be back at all-time highs even after a Lehman event just a few months later.
It is the case, though, that we are in a bit of uncharted territory in some respects in gold. I mean, the change in central bank buying over the last 2 or 3 years, central bank, certainly diversification is a consistent theme. We don't really know how much they're buying. The reporting standards are iffy. IMF officially has gold reserves going from about 10% to 20%. Gold ownership as a percentage of GDP is the highest it's been in 30 years. There are a lot of metrics that are, above 1985 levels. And so I guess the question that I always ask myself is, okay, we're in a new price regime. To what extent is there a supply response? In any commodity, and we talked a lot about this, how can this problem solve itself? Is there immediate supply response possible in precious metals?
I think the first response that you're already seeing and is very visible on the ground is the substitution impact that we comment on, right? So I always joke, and unfortunately mine is already platinum. Is your wedding ring going to be made of a platinum or gold going forward? And this was decision 13 years ago, obviously not foreseeing the current market. But basically, gold and platinum has competed in the precious metals for the high quality. Actually, most of the historically, platinum being a premium product to gold. Now platinum is 1/3 of the gold price. You're already seeing the substitution happen immediately into the jewelry market. So that one is the first one to move. The second one to move is one that I'm personally observing quite carefully is when do you start moving your inventory? So when do you melt your jewelry? At what point do you become flexible in terms of your current gold holdings that you melt the recycling? When does the scrap rate of gold comes up? And you're already seeing in China these machines where you can put your jewelry, they will melt the jewelry, they will calculate perfectly how many ounces of gold is in there, and it will give you the money, like a gold ATM, can we move into this market? It's not that unlikely. The machine apparently doesn't cost that much to ramp up and create supply out of that. So I would say that there is a price, but the price sensitivity for that kind of move seems to be much higher than what we think, because the expectation is that the gold price will continue higher, so people hold that as a storage as value. And particularly when you have your currency depreciating, and the US is the first time you're seeing that, you really see your loss of value in your holding your currency, so that the demand for holding value into hard assets increases quite a lot. And the other, big trend I will mention is that this is the first time in the past, let's call it 3 years, where China has been wealthy, and yet its stock market and real estate market, where most Chinese people hold their wealth, have been going down. Now the stock market is rebounding, but the real estate still, finding its foot on the bottom. And that created an immense amount of demand from the Chinese retail side as well. So you've seen this demand for gold compounding on itself. It started with the central bank, then come Chinese retail buy. Now we started to see institutional buying of gold, and soon we're going to have the de-dollarization buying. All these trends coming together into what we see like kind of, the role of hard assets and commodities in your portfolio.
Also, I'd like to point out, talking about institutional buying, retail is not yet involved as much in purchasing of gold. The last several years, there's been a lot of inflows to crypto ETFs that's been competing from those flows that could have gone into things like gold ETFs. By the way, speculative length is not stretched. And I was reading an interesting study from JP Morgan. They said if you look at the total amount of assets of foreign holders of US assets is around 57 trillion. If there's selling of about 0.5% of that over the next 3, 4, 5 years, that could easily drive gold prices higher by a few $1,000s. You could easily keep getting double-digit returns in gold, for the next 3, 4, 5 years, if that were to happen. The dollar is in a secular decline. President Trump likes it. It's supportive of his global trade policy. And a lot of these reasons are what's flowing some capital into gold.
Okay, we've got 3 minutes left. I do one quick question. Let's do a round table, starting with you, Stephen. End of the year. Hypothetically, the way I see gold right now, it's priced for a lower U.S. stock market, potentially Fed ease, potentially deflation, like what's happening in China. Any thoughts, any views on that, where you think the market's going to end in the year? And to me, that's an iteration that's bullish for gold. What if we get the opposite? Stocks keep going up. Seems to be the problem for hard assets like rocks.
So if we're still talking about gold, I am...
Well, go where you want on the end of that. So we got a few minutes. Your final thoughts.
I'm much more focused in kind of faster trading with differentiated data and, just this laser focus on execution and the China access. But to gold, to be controversial, I would say gold's at, 5,000 end of year. I think if stocks go up, it makes it easier for gold to go up. In the end, gold is still a risk asset. So I would say safely gold 5,000, either through good economic positive growth or through an accident. Both take gold to 5,000, and interest rate cuts will certainly be helpful.
And I forgot to mention, no Bitcoin in that space?
I think Bitcoin, either direction, it's so you're talking to gold bulls, right? Bitcoin up, positive for gold. Bitcoin down, positive for gold. I think the best thing that Bitcoin has done for gold is that it's shown the world that if Bitcoin can be 100,000, well, gold can sure as heck be 100,000.
Yeah. Aline, your thoughts?
Absolutely. So in terms of commodities, I would say that, the individual fundamentals is very idiosyncratic. So I'd say energy and oil likely continue a downtrend from the OPEC supply coming up. Gold and other precious metals, particularly the ones connected like, platinum and silver, continue to go up as well. And I'll pay attention into the copper space, looking very interesting, quite tight on the physical fundamentals. It is quite likely that by August or September, the LME will run out of inventory on copper, and what happens there could be a very interesting story for the next panel.
Mike?
Yeah, as far as gold goes, I would say amongst overall very bullish panel, I'm probably the biggest skeptic. I think it is possible that we consolidate here, and I think there's a lot of uncertainty in how tariffs play out and what the world looks like if we are successful in negotiating some of these trade deals upcoming, as well as some of the more diplomatic actions. And things I'm most excited about, certainly on oil, I think there's a strong potential to see prices move lower. And I think we need to be laser focused on what summer weather looks like this year in North America, and especially over the winter in both the US and in Europe. And I think, consistent with an AI story, which I think is a dominant theme, which could crowd gold investment out, is what how load growth materializes and how power prices look into this year.
Jackie, you have the last word.
Gold higher, north of 4,000. It'll take silver up to north of 40. U.S. equities end the year higher. U.S. equities are lagging a lot. There's plenty of room for catch-up. But I think the fact that, like Stephen said, if Bitcoin could be 110,000, that just kind of opens the door to where gold could go. It just has to take out its prior reactionary highs. And hard to call a top, but the trajectory is higher.
Thank you very much.